Now, it is with great pleasure that I announce our opening keynote speaker. Trey Reik has 37 years of investment experience, including the past 18 years of comprehensive analysis of the gold industry. He has been a senior PM and precious metal strategist at both Sprott USA, Bristol Investment Partners, and Apogee Gold Fund. He's a renowned expert on gold markets, monetary policy, global credit, and other influencing factors. Please join me in welcoming Trey.
Good morning. So we're getting together the day after the largest point drop in the history of the Dow. It's kind of exciting. Interesting times. As this is coming up, I will point out that I've been doing sort of gold-only investing for, this is the 19th year, and over that time, I have literally given thousands of presentations about gold, and I've learned three things over that time frame, which really order how I approach this. Number one, in all those presentations I've ever given, whether it's an individual or an institution or a board of trustees, I have never once convinced anybody to buy gold. So it's something that has to come from inside, internally. I can present the facts, try to be a credible messenger, but I'm pretty certain I'm not going to convince anybody today of their views of gold. I can only add what I think is an interesting structure to look at what's been going on and explain gold's move over the last 2 decades. The second thing is there's no investment asset which has more divergent investment cues than gold. So some people think it's an inflation hedge. Most people think it's an inflation hedge. I personally don't really care much about CPI inflation when it comes to my views on gold, but I've learned that I'm just Trey, and if the rest of the world needs CPI inflation, maybe we need CPI inflation. Some people look at gold as a deflation hedge. Some people look at gold as sort of a risk-on trade, other as a risk-off asset. In times of stress, some would find gold attractive, as we seem to on Monday, but as in this morning and yesterday's trading, some people would find the dollar, believe it or not, is still the safe harbor, and given the inverse relation between the dollar and gold, that can actually put some pressure on gold. What's funny about all of these investment cues is that they're ever present and they frequently occur at the same time. So we really don't know what's going to move gold until the end of the day. And then the third thing, and this is a different group because I think the gold IQ is probably pretty high here, but one thing that I encounter all the time is that people have very strong opinions about their gold view, usually unburdened by strong hold of relevant fundamentals. So it's a pretty emotional topic. Most people have no idea what they're talking about, but I wouldn't ever try to change somebody's mind about their gold view, because it's hard to do. It's funny, I see a couple of my Sprott colleagues here in the room. I have taken a lot of heat over the years for using the same slides. And people ask me all the time, why do you keep using those old slides? They're not that interesting. And the answer is the thesis behind gold never changes. The only thing that changes is things like the coronavirus, et cetera, and people's perceptions. But in my view, for the past 20 years, it's been a really consistent move. So this is the performance of gold in the world's 9 leading fiat currencies for each of the past 19 years. Now, what's funny about this is for an asset that has so little institutional following, there's not a lot of red on this slide. The past 19 years in the 9 global currencies around the world, there's really been 2 years where the average of the move in these 9 fiat currencies was not positive, and they were 2013 and 2015. For the rest of this entire 2-decade period, and we're off to a pretty strong start in the first 2 months of 2020, gold has posted these positive returns. Now, if you're wondering why I would stand up at a conference and talk about the 20-year history of the price movement of gold rather than looking forward. The reason is it really is important to recognize or to think about, given everything that's happened in the last 20 years, why does gold go up almost every year? There's been, two rise and falls sequences for just about every investment asset. Stocks have risen and fallen, commodities have risen and fallen, rates have mostly been falling on both the long and the short end. But there were periods like June of 04 to June of 06 where the Fed raised rates at 17 consecutive FOMC meetings and quintupled the Fed funds rate from 1 to 5.25. Imagine if we did that today. And even in that stretch from June of 04 to June of 06, gold went up a peak of 87% in that 2-year period. So my point is, everybody has to try to figure out, their personal framework for what gold represents and what's happening. My personal framework is there's obviously something going on that is a little bit more important or overarching than the typical knee-jerk reactions that we read about gold in the paper on a daily basis. Inflation edge, euro weaker, Greece, stress, coronavirus. So my view is the thing that connects all of these positive performances is a migration of wealth. And my theory is, each year, some small fraction of global financial assets, maybe 0.1% from that $280 trillion global financial asset pile, seeks to get out of what could be perceived as overpriced assets or the dangers of the financial system and seeks a resting place outside those dangers. Gold is a fixed asset, hard asset, just like Honus Wagner baseball cards or fine Bordeaux wine or art. And I think that's why the art market has been just storming hot for the last 10 years. A little bit of that global wealth, 0.1% of 280 trillion tries to get the investable gold stock, which is about 3 trillion. And the whole gold thesis is not about Armageddon or the dollar collapse or Weimar Republic inflation. It's just about that rate of migration going from 0.1% to say 0.5%, because 0.5% of 280 trillion is 1.4 trillion, and 1.4 trillion can't get into 3 trillion without a fairly positive move. So that's really what I think unites gold's performance over the last 20 years. Now, some would say this is looking way back, but the other point of gold is that when stocks are really, really overvalued, gold becomes an interesting portfolio addition to protect against the eventual downdraft. So dating back to the end of 2000, in other words, if we take all these years, those 19 years, and we connect them, the top line is gold. Gold's up about 502% since the March 2000 peak in the S&P. The red line is the S&P itself without dividends. It's up about 145%. This is from the end of 2000. And then the purple line is the S&P with dividends. So that's posted about a 245% return. Measured from the actual peak of the S&P in March of 2000, which is that first red circle, the internet bubble led to a 51% decline in the S&P from that peak. It's about 1552 on the S&P, March 24, 2000. Well, after that 52% or 51% decline in the S&P, it took 7.5 years for the S&P to get back to that level, and it hit it in July and October of 2007. Of course, it promptly fell 57% from that perceived bubble peak. So anybody, who's bearish on gold and bullish on stocks would point out, well, this is because you're picking March 2000 as your starting point. Of course it looks like this. And my answer is, that's exactly the point. So we had these red circle, green circle, those were bubble tops. What the heck should we call this purple circle up there? And the point is, it is very likely that gold will provide the same protection whenever this blow-off finally chooses to stop over the next 20 years. Interestingly, even though gold, and it's very important to pick your day these days, when we did these slides again on the 26th, the S&P was 3,116, I believe. And at 3,116, that marked a 101% increase from the March 2000 peak. Deflated by gold's move, though, the S&P is still down, as of the 26th, 65% from its all-time high in gold terms. So back to this group of numbers, you know, what's powering this consistent gravitation, migration of capital to gold? And the answer is this. So talk about a boring slide. If I had to pick one image to reduce the gold thesis, my 20 years in this glorious life I've been living, this is really the slide I would pick. This is what it's all about. This is debt to GDP in the United States for the past, 100 years or so. And this ratio generally is between 140 and 170%. There were two black swan events that broke out of this range. Keep in mind the ratio of debt to GDP. The first was the Depression, and in 4 years, output fell 40%. The debt remained constant, and FDR had to devalue the dollar 40% versus gold, and quite frankly, outlaw private ownership of gold for what turned out to be half a century. I was born in 1960, and when I was 14, it was still illegal, federal crime, to carry these gold coins in my pocket. The second aberration was the Greenspan, Bernanke, Yellen, Fed era, and that was more of a numerator event where we piled tens and tens of billions of dollars of non-productive credit on top of fairly stable GDP. So why is this important? What does it have to do with gold? Well, in order to get this back in balance, we're going to have either about 20 trillion to 30 trillion of credit in the US go away through default or debasement. GDP, in my opinion, of 21 trillion has zero chance of growing into 74.9 trillion in total credit. And that requires fresh new credit creation each and every year. And when the economy can't provide that, the Fed steps in with QE1, QE2, QE3, and now not QE/QE4. Now there is this perception, and again, why is that important to gold? Because the only options to get this much credit back in line with underlying productive output is through default or debasement. And gold can neither default nor be debased. Last point on this slide, there is this perception, very widely held perception. In fact, almost everyone believes that the United States has been deleveraging since the financial crisis. That's an abject falsehood. The debt to GDP ratio is still close to its all-time peak, and consumer credit, which was about 14 trillion at the end of 2007, is up 12% to 16 trillion. Mortgages are flat, rolling credit is up, and the government contribution to this debt bonanza is a tripling from 6 trillion in 2007 to 18 trillion today. We haven't had negative rates in 5,000 years. Going back to Mesopotamia and Babylon, it was generally a 20% interest rate in the first 3,000 years of recorded history. Then 300 years of stability in the Roman Empire got things down to about 4%. And then for the next, 2 millennia, we bounced around in the upper single digits. With respect to the Fed, even World War II and the Depression never caused the appearance of negative rates in the United States. However, some promiscuous central bankers, largely in Europe, decided that it was time to test negative rates. So this quote at the bottom is my favorite to sum up the promiscuity of central banks during this period. This guy, Vitas Vasiliauskas, is the Lithuanian central bank governor, but an ECB governing council member in mid-2016. And he says, markets say the ECB is done, their box is empty, but we are magic people. Each time we take something and give it to the markets, a rabbit out of the hat. Well, this is what they gave us, negative rates. This, on top of further and further bond purchases, QE programs, et cetera. Everybody's seen this chart before. By August of 2019, we were up to 17 trillion in negative yielding global sovereign bonds. 17 trillion. Now, I just told you negative rates are absurd. There's absolutely no possible explanation for why they exist in reality, capitalism, et cetera. But we got up to 17 trillion. So what I have been hoping for, or writing about, is that when this total starts to fall, because I think the negative rate, interest rate experiment is ending ignominiously with very little to show, my thought was gold should separate to the upside because gold is going to be more concerned about the corrosive and cumulative damage of these negative rates rather than being linked at the hip with the absolute amount, and that's been the case. Some of these things sound virtually trite, but this January was the fourth month in a row of a trailing 12-month federal budget deficit in excess of $1 trillion. It was down to $400 billion just a few years ago, and now we're back to $1 trillion, and I don't see any possible hope that that number doesn't get worse and worse over the next 3 to 5 years. So skipping ahead, if you look at the correlation between the federal budget deficit and the gold price since QE3 was launched, it's pretty darn tight. And if you pick your number for the deficits that you expect in the next several years, 1350 is at the bottom of this chart, that implies a $1,900 gold price. Of course, this was through the end of November, which is the most recent data. So there's the budget deficit. And the problem is that at exactly the same time that the current administration is vaulting our budget deficits north of $1 trillion, foreigners are really blanching on treasury purchases, given the amount of sanctioned people and countries, et cetera, in this country, in the world. It isn't difficult to imagine why foreigners are less interested in purchasing our treasuries, not to mention the fact that hedging costs, et cetera, make it somewhat onerous. So at exactly the time we need more money to finance this blowout in the deficit, foreigners have stepped away. So in the most recent month, which was November, the annualized 12-month Treasury purchase rate was negative $251 billion, and that's down in a few years from 2010 to about positive 800. So we've had $1 trillion run rate decline in net foreign interest, which leads to this slide, which is sort of the modern equivalent of my 19-year gold price history. The red line is the Fed's balance sheet. So we spent 6 years quintupling it from 900 billion to 4.5. And then we went 3 years sort of flat. That was after the final taper. And then we spent 22 months at very, very graduated pace, letting these assets run off the balance sheet. So it took 6 years to add 3.6 trillion. We took 22 months to subtract 750 billion. And pretty much the Fed is now admitting that was a terrible mistake. So we have, in 4 months between August and the end of last year, repurchased 55% of what was sold. It's a different asset, treasury bills rather than bonds. But 415 billion, that's 55% of the 22-month decline in just 4 months. And the current treasury bill purchase program is going to get the Fed's balance sheet back to an all-time high by the end of the second quarter. Now, everybody can say, well, this, everybody knows this, blah, blah, blah. Why does the Fed need to have a $4 trillion balance sheet? Didn't need a $4 trillion balance sheet in 2007 or 8 or 9. They built it that way, and by the way, every QE program followed months of speculation about when we were going to sell the assets the Fed bought in the prior QE program. So after QE1, the debate was when we were going to sell those assets. Then we had QE2. Then the debate was when we were going to sell those assets. then twist, then 3, then 4. Nobody even talks about it anymore. But what has changed in the US economy where the Fed needs a $4 trillion balance sheet? And that goes back to the debt to GDP slide that we looked at earlier. There's still too much debt, and it hasn't gone anywhere. By the way, if you think the Fed is nervous, people forget that in 1999, in October 7th, the Fed launched a liquidity program, essentially through repos. The Fed's balance sheet was $569 billion at the time, but the Fed was worried about Y2K. This was when we were going to do the rollover and all the computers were going to freeze. They turned off all the elevators. Well, just for that, the Fed increased its balance sheet 21%. The reason I show this slide is everybody remembers the NASDAQ surge, right? Through March of 2000, that last 6 months, the NASDAQ basically doubled. What I'm pointing out is nobody recognizes how much of that was caused by the Fed's repo program, very similar to what they just did in the fourth quarter of last year. So the Fed started the program on October 7th, ended it on April 7th, 2000. In the meantime, the NASDAQ went up 76%. And interestingly, the day that the Fed stopped the program, April 7th, in the next week, the NASDAQ fell 26%. So the Fed's repo programs have always been inextricably linked with ridiculous equity moves, and that's why I think they're extremely nervous to roll back the liquidity that they started in the current repo kerfuffle. We looked at that one. So what's different, or why am I excited? There are two signs in the recent gold sort of technicals, if you will, that imply that we're near a turning point on this whole ridiculous run for the S&P, et cetera. The first, this is the Dow and the Dow to gold ratio. So really starting back in October of 18, the Dow's continued to escalate into the stratosphere, but the Dow to gold ratio has not. And most recently, even in extreme strength in the S&P and the Dow, you might say, why do you use the Dow? These are just older and more high-profile ratios than the S&P to gold. But the Dow to gold ratio, which is a very venerable index, has really been telegraphing a turnaround in the broad stock advances. Another thing, this is a little technical, but in that $100 late 2018 correction in gold from 1550 to 1450, 100 bucks, one would assume that the CFTC figures would demonstrate a flushing of what they call specs, you know, the non-commercials, but it was much more stable than normal in a $100 downdraft. You may recognize, Rudy, those numbers from your colleague. And this is in the context of all-time outstanding interest. So clearly there's a new breed of gold investors in town. I've always said if gold's really going to break out to the big one, we need to increase, you know, the volume and participants of people involved. So it's quite natural to me that outstanding interest would go to a new zip code, you know, that we've never seen before because we're bringing more people in. But that's sort of talking my own book. So it's fun to see it actually happen. But these are new people involved with very deep pockets. Can't spend too much time on this, but I've just tried to find a couple of slides to talk about the S&P. We've lost all superlatives, every possible value measure, price to sales, price to earnings, price to, you know, EBITDA, enterprise value. They're all at all-time highs. What I find amazing, that sort of flat, thin black line, which has been flat-ish since 2012, is the Fed's measure of U.S. after-tax corporate profits without inventory and capital adjustment. But after-tax profits have been flat for 7 years, right? Most notably, last year, the S&P earnings were flat, and the S&P churned out a total return of 31.5%. How is that possible? Flat earnings, second best performance on the S&P in 22 years. Well, the answer is the multiple, forward multiple, went from 14 to 18. That may not sound like a lot, but it's never happened outside of coming out of a recession. The concentration at the top of the S&P is just like the internet bubble, the top 5 companies about 18%. Here's the Fang thing. All I would say is, this is beyond nuts. We've all watched these, it's really 10 stocks. This is the Fang plus 5. But the stored force of when the S&P starts to decline in terms of rollovers to gold is going to be enormous because gold is such a smaller available stock. I've already been given the signal, but just briefly on equities, this is the XAU to gold ratio. For 30 years, it was 0.25. We've gotten down to 0.06. There are reasons for this. More stocks in the S&P, more XAU, more shares, more difficult projects. But this is a classic Grantham reversion to the mean opportunity like I've never seen. This is a little confusing, but this is the ratio of gold to commodities. When gold breaks out of the commodity pack, it really puts gold miners in a position, believe it or not, we forget this, of earnings growth. So in 2008, when gold closed the year up 5%, commodities were all down 50. That set the XAU and HUI for about 40% compound earnings growth for the next 3 years. Skipping to the end here, we clearly have gold breaking out from the commodity pack, and my experiences in Hollywood on Monday and Tuesday of this week, gold companies are really, if this continues especially, in a position to post some gangbuster earnings numbers. There's been 2 periods of inverse correlation between gold stocks and regular stocks. The regular stocks, the S&P is the black line here. Cleverly colored gold is the GDM. And in the first instance from 96 to 2000, we talked about that leading into that peak. Stocks went crazy, gold stocks were abandoned, and then that first 52% decline, gold stocks tripled. Skipping the middle, we call the right the jaws of life in our office. So it literally looks like, the mouth of a monster. It was all closing in 2016. The S&P was rolling over, gold stocks were doing their thing. Reversion was here, and Trump was elected, which short-circuited the process, if you will. The top left is the blow-off on the S&P, but notice gold stocks have been sort of flat over this time period, and I think it's going way underappreciated that 31.5% total return for the S&P yesterday was trounced, last year, was trounced by the XAU, which was up 53. And if you go back over 4 years from the December 2015 low, in the past 4 years, the S&P has cranked out total return of 71.5, and the XAU more than doubled it at 143. So we've already started the process of gold stocks outperforming, and this is my last slide. There's a little bit of chicanery here, but if we look at the 4 moves in the GDM over the last 20 years, they were up 342, 185, and 309. And I've measured it to the day here. Over the same 3-year periods, the S&P was down 22, up 10, and up 39. Now, obviously, the problem with gold stocks is timing. And so I've had colleagues who've said this is irresponsible to point out what I'm about to say, but the linked performance of the GDM and the S&P over those 3-year periods is 5,000 to 22. So it means that for 9 of the past 19 years, or about half the time, gold stocks have outperformed the S&P by a factor of 249 to 1. Now, the reason that's not that relevant is the corrections have been very severe, down 34, down 85, and down 70, which is about 100%. So recognizing that timing is relatively difficult, our point here would be that when faith in U.S. financial assets is being recalibrated, I've never been trained, never say stocks could go down, right? That'll clear out a room quickly. But if that faith is being recalibrated, gold shares, we believe, are still perhaps the most potent source of portfolio alpha out there. Notice in the 2016 run, that outperformance started again, and maybe we're on a new path today. So I think we're in a great position over the next year or two for that stored force of these incredible advances in Fang stocks and S&P stocks to transfer to a really, really positive performance for the gold shares. Thanks.